we're going to rock and roll. And if anybody joins, I could give them a recording after. So let me see, where can I click? This, by the way, this is my first webinar, so give me some grace today, please. But so why we're meeting today? A lot of clients right now that own a home and are looking to buy something new are running into a few different things. There's a timing gap, right? So people that need to sell their home and then they need to buy. There's the weak offer component where if you're competing against people with waiving their, if anybody doesn't have a Hubbard clause, they're going to be a better offer, especially if they're waiving appraisal, mortgage contingencies, maybe they're offering cash, and then you're ending up losing deals for clients as well. So those are the big things that we're running into. And I noticed that a lot of bridge loans that other companies were doing were only against the equity in someone's house. They were still putting in contingent offers. So it wasn't really elevating their offer and giving them a better chance to secure and win a home. So how it works. So we pre-approve clients up front for the end mortgage. So the way the cash offer ends up happening is we fund 100% of the purchase price of the house that they're going to buy. There's no Hubbard clause, no sale contingency needed. They close on the new home with no money out of their pocket if they want to do. All of the closing costs can also be rolled into the loan we give them. And then they get 4 months to sell their old home. And there's no monthly payments. So the interest that accrues is not paid until the sale of their house and they have enough money to pay us back or refinance. So clients don't have to worry about making 2 mortgage payments. They get to buy the house and move into it, and there's no money out of their pocket, which I think is why it's been so successful. And by the way, we've done about 45 of these since last May. So I always like to start with what are the alternatives and why might someone say, you know what, the cash offer program sounds great, but it's not worth it. So
we can't hear you. I can't hear you now, Gaetano.
Can you guys hear me okay?
No.
Perfect. Sorry about that. My mic there. So you have clients that want to sell first, then buy. So where do you go? If they end up moving in with parents, that is by far the cheapest option. Not everybody wants to move in with their family, though. And if you have to move somewhere, it means you're going to probably be paying storage costs, right, at a local storage, self-storage facility, and you're going to end up having to move multiple times. Second option is renting the house back from the buyer. So you could sell a house, then rent it back for 2, 3, 4, even 6 months. The problem is, 1, you're paying rent, but 2, you might not find a home during that time period that you love and want to move into. The third thing is an extended closing. You can always go under contract and then allow seller to find suitable housing, but not every buyer is going to want to agree to that. That limits your buyer. Some people want to move in 30 to 45 days, so they might not be willing to do that. And then you also have to find a home that you love in that 90 to 120-day period, which might not always happen. And then the last one is the Hubbard clause sale contingency, which if you're competing against multiple offers, it's not a strong offer. So with our cash offer program, it allows a client to find a home first. If they find a house they absolutely love, they get to move into it. They then get 4 months to sell their old home. So I tell clients, you probably will net more money by selling this way than if you sold your house first and then buy. Because we'll talk about some of the target profiles of potential clients. And if you're a move-up buyer, you need more space. You have 2 or 3 kids now, you have a dog. For you to try and sell your home while you're living in it versus selling your home after you moved out, you can clean it up, renovate it, stage it, host a real weekend of open houses. You're probably going to get more money than if you try to sell it while you're living in it, because you probably won't want to do any repairs or touch-ups just because you have to coordinate the kids, the dogs, the whole family. Any questions on this slide? I'll give a quick pause.
Nope.
Awesome. So why have we done 45 of these? It's because it's helping clients win more offers. They find a house they love, and it makes it so easy to buy a house. It takes their offer from a Hubbard clause, which is at the bottom of the pile, and we actually turn it into a full cash offer. So there's no appraisal completed. There's no appraisal contingency. There's no mortgage contingency, and we can close in 10 days. So it completely elevates a client's offer, which helps them bridge that gap from selling their home to buying. And then when the time comes to sell their home, I've seen, though, that we are selling homes. Our average loan duration is 2.7 months from when we give the money to when they sell. So people are moving very quickly once they're in the home. And they're able, like I said, to renovate and stage so that they're getting top dollar. So just to reiterate, this is it's 100% of the purchase price and closing costs if they want. There's no monthly payments. There's no cash out of their pocket. Equity requirement. There is no equity requirement. So we don't require someone to have a ton of equity in the home they're selling. I had a client moving from Meriden with 3 kids and a dog to North Haven, and their house was worth roughly, we thought it was going to be like 380 to 400, and they owed about 325. So before closing costs, we thought 75K of equity. After, conveyance fees, agent commissions, they might only walk away with 40 to 50,000. They ended up selling for a bit more, but the way the program works is we pre-approve our clients for the cash offer based on the end mortgage. So even though they only had 50K of, cash they were going to walk away with, they bought a house for about 660 in North Haven. Once they bought and sold their house in Meriden, they were left with 50,000. We only needed a 5% down payment on the bridge loan program to qualify them. So they needed like 33,000 plus another 10 in closing costs. It was a total of about $43,000 to make that work. So the equity requirement is not needed. All that matters is, can the client qualify for the end mortgage? One thing I will note there is we are not originating this loan unless we are certain the buyer is going to qualify for an end mortgage. In that case, they had some money in brokerage accounts that we've talked about that they could potentially sell if they needed to be able to bridge the gap if they were short money for the down payment. And then, so the offer strength, it's cash-like, there's no sale contingency. And then the repayment only happens when their home sells or the long-term financing closes, which is what we'll be doing for them. So the loans are 4-month loans with an option to extend for 4 months. We've only had 2 people, by the way, go over 4 months. So most of the clients are paying us back in a short time period. I had someone selling a house in Essex. It's on the market right now on River Road for $2.5 million. We gave him 6 months because it takes longer to sell a home in that price point. So we were able to structure that up front for those higher price point homes. So this is the ideal client profile. You have your move-up buyer, right? The family's growing. They need more space. They want to make an offer and then sell a home. We've done just for people that need cash, that want to be a cash buyer. We don't see this one too much, number 2, because we're an advocate. We just say, let's waive your appraisal contingency and your mortgage contingency. That almost turns you into a full cash buyer if you have no contingencies in place. That usually gets the job done. Number 3 is relocation. So if someone requires a fast move, I had somebody, one of the case studies we're going to look at, move from Pennsylvania to Connecticut because of a new job. They had to sell their home to buy something new. So that was a client that we were able to help. And then the last one's the downsizer. People that might be empty nesters who want to sell, who have a ton of equity in their home. They don't want a mortgage, but they want to buy first before selling. Now, the reason why the move-up buyer and maybe relocating family, this program works great for, is because the move-up buyer, they already have a mortgage payment right now on the house that they currently live in. They will not qualify for the mortgage payment of the house that they currently live in, plus the new mortgage payment. Their debt to income ratio is going to be too high. That's why this program is great, because we don't look at debt to income ratio on the way in, up front. We can exclude the house they're currently living in because we know they're going to sell it. So we give them the cash, they move in, they sell their home, and then we're only qualifying them on the end mortgage for the house that they end up buying. If this buyer, this move-up buyer, let's say, can carry both mortgages, then you don't need to use this program. It's only if they can't afford both mortgages at the same time, which is a lot of people. So here's some case studies that we'll just quickly run through to give you guys ideas of what kind of clients we've helped with this program, so that if you're out looking at, talking to people, they might have been turned down other places, we might be able to step in and help. So Laura was moving from Stanford and found she wanted to buy a horse farm. She found one in Southbury. She was not going to qualify for a mortgage at this price point with her income, but she had enough equity in her house in Stanford. So we were able to close back last July, August timeframe. We gave her 100% financing on this purchase. Actually, she put down the deposit, which was about 10%, but we ended up financing the remainder portion for her. All we look at, we took an application, credit report, we got a broker price of opinion from 3 different people on our house in Stanford to make sure that it was roughly worth what we thought it was going to be. Ended up selling in the high 9s. And then we structured the bridge loan to let her buy in Southbury. She ended up selling her house in 3 months to pay us back for the money we gave her. Now, she did not have the income to qualify. So she was not quite downsizing, but that was the profile. It was an older lady that was looking to buy but didn't have the income to qualify for a mortgage. The other alternative was she would have had to sell her home first. But because the property she was looking at was so specific, when it came on the market, she had to move quickly. The second is also a downsizer. So Chris and Bernie DeLeon were referred to me because they owned a house in Waterford looking to move to East Lyme. A lot of people we've run into, probably like 4 or 5 of these, have a lot of assets in retirement in an IRA or 401k. So you might have clients that are thinking about downsizing. And if they have money in a retirement account versus a brokerage account, it's very different. Because with a retirement account, like an IRA, if they were to liquidate, they would have had to pay, if they didn't pay it back within 60 days, they would have been on the hook for capital gains taxes and penalties. So we were able to structure for them a bridge loan, which if you look at the bottom of the outcome, it costs them about $23,000 versus the $80,000 they would have paid in capital gains. So we gave them very similar, close to 100% for the purchase. They were able to buy the house in East Lyme. Then they sold their house 2 months later in Waterford and paid us back in full. So both of these first 2 scenarios, there was no end mortgage. These clients were able to pay us off in full with a sale. This is Sarah was referred to me from someone she grew up with. He's an agent up in Waterbury Metro. She's moving back from Pennsylvania to Connecticut. She was starting a job in June, so she needed to move quickly. She didn't have time to put her home on the market and sell it. but she did not qualify for the current mortgage she had, plus the new house here. And because she needed to move, she wanted to make her offer as attractive as possible. So she bought a home for about $459 in Woolkit. We gave her $465, covering the entire purchase price. She put up the EMD and we covered the closing costs. She moved into the property. She started her job. She had 3 months, or well, she had 4 months, but within a very quick time period, was able to get our house under contract, sell it, and then she took the proceeds from the sale of her home, which at the time was probably about $200,000 or so, and used a portion of that as a down payment against the bridge loan we gave her. So she walked away with $200,000, but as you can see, she refinanced into a $350,000 mortgage. We gave her $465, so she only put down about $120 with closing costs as well, and then kept some money for herself. The outcome was she ended up with a 30-year mortgage at $3,200 a month. It was at market rates at the time, wherever those were. But it allowed her to be able to be a full cash offer. The house was competitive, so no appraisal contingency, no mortgage contingency. She moved into it, sold the house in PA, took the proceeds, and then we were able to originate a 30-year mortgage for her. So that was an outcome where you have somebody relocating, but also a move-up buyer could have been somebody good there. And then this was an interesting one. So this is a little bit different. And this bridge loan that we did, the client had a credit score of 540. So most bridge loan programs that I see out there have minimum requirements for credit scores. We do not. This client was referred to me from Mulberry Gardens, somebody who's the who could be a great referral partner, by the way, for any of you, anyone in assisted living, but called me up because they knew I did bridge loans. I don't know how they quite found out. This client had a house in Waterbury. It was worth about $300,000. They had a first mortgage of $90,000. So I know they had about $200,000 of equity. They spoke to a couple other places though, and because of their credit score, could not get approved for anything. We looked at it and said they've got more than enough equity. They would be able to buy the house. Excuse me, they needed to pay off their first mortgage. They needed money to pay off some credit card debt and move into the facility in the Mulberry Gardens. So what we did is we structured a bridge loan for $172, which covered the move into Mulberry Gardens, paid off some credit card debt, and paid off their first mortgage. They were able to move into Mulberry Gardens. And they were a 93 and 94-year-old couple. Their daughter was like in her 60s, was really kind of driving the ship here and helping make it happen. The daughter was overwhelmed. She was wondering how is she going to come up with the money to put her parents into Mulberry Gardens. The alternative was like, where would her parents move to? Because she couldn't have them move in with her given the layout of her house. But she needed the money to move in and give a deposit for a room. So we stepped in, we gave them the money, they moved in, then they ended up selling their house and it sold relatively quickly. I think it was like 2.5 months. And they paid us back at that point in time. So for us, we're going to look at credit, but it's not the most important thing. So that was the case here. And it's another scenario where if you have something that might be interesting, it might make sense, but other people are denying it, we will 100% look at it. So that was it. I went through a few examples. Do you guys have any questions?
Gaetano, how are you getting around the capital gains tax if they do have a lot of equity in that? Because they still will need to sell their home.
So for this client right here, they had a capital gains tax from if they sold money in the IRA, from the IRA.
Okay.
But from a capital gains perspective, if you live in a house for 2 out of the last 5 years, you you are exempt from paying capital gains on $250,000 of gain, or 500 if you're married. So like this client, if we look at this, they sold their home for 600. They probably bought it for 3. They had a $300,000 gain. They don't have to pay any capital gains because they lived in
Oh,
it
got it.
the last
Okay.
5 years.
Thank you.
Yeah. If you have married clients, they're probably not paying a capital gains because they don't have more than $500,000 in gains.
Quick question, Gaetano. With the relocation examples, what other states are you licensed in? Like, did you have to be licensed in that state, or that's just communicating with the realtor in Pennsylvania to make sure it's under contract, pass inspections, all of that?
Good question. So we're licensed in 17 states. We just closed about a week ago for a guy moving from Texas to Hamden. We're licensed in Texas, so I was able to put a lien on the property. So if we're not licensed and I can't put a lien on the property, then I just have to get creative on what to do, right? Or look at the deal. But that hasn't stopped us yet.
Okay, thank you.
Awesome. Jill, Kurt, Kathleen, any questions? We're all set.
I do have kind of a question. Is there a way that you could put something together for us agents that we could send to some prospects and clients? Sometimes we know a little bit about this, we're learning more about it, but how to put it in a one pager so we can send it to our clients that this is available.
For sure. So I'm gonna have Maddie on my team email you the one pager that we have.
Okay.
So that if you are meeting with anybody, you can present it. And I'll have her send a couple case studies, because if you have specific, I have 40 case studies, by the way. So when I talk to clients, I will actually send them case studies of very similar scenarios that we've helped, because that helps them visualize and then be confident that we can help them.
Okay, thank you.
Awesome. Jill, I know your mic's not working. All good.
I do have another question.
Yes.
What are the points? I know it's similar to like hard money. So what are the interests that the client would be paying on the upfront loan before it actually closes?
Yep, I just realized I didn't even cover that. So, yeah, by the way, this isn't free. So, there's no upfront cost, but there is a charge. So, the origination fee is 2.5%, and the monthly interest is 1% per month. So, if somebody, let's say, needs a $400,000 loan to buy a new property, or in this case, we'll call it $500,000 if we round that up. 2.5% is $12,500. And if it takes them 3 months, we'll call it 1% per month on 500,000 is 5,000. So 5,000 times 3 is 15,000. Plus the 12.5, you're looking a little over 27,500 for the 3 months for them to have it. The one thing to note there is they don't have a mortgage payment during those 3 months. So that 5,000 would be a little bit more expensive than if they had a 30-year mortgage. So it's not an actual cost, but more so the spread. Maybe their payment would have been like $3,500. They're paying an extra $1,500 per month plus the origination cost. And then I always break it down for clients right here of moving multiple times, storage, and what they're going to, be looking at, costs that they might not realize up front, as well as moving in with, I always say moving in with family is the best thing for you, but not everybody has that option. Awesome.
Gaetano, I'm sorry.
Yeah,
Are you able to send us these slides so we can review?
for sure. Yep.
Thank you.
So Maddie's going to send everybody the slides after this, plus the one pager. And then the only other thing, if you meet with clients potentially and you want case studies, we could send you a few of those too. specifically for like if you give us that idea of what kind of client you might be meeting with. False. If anybody has questions, you guys can just text or call me, Nick, Vito, and we'll go from there, okay?
Thank you.
Thank you so much.
Excellent.
You're welcome, guys. Have a good day.
You
All
too.
right. Keep up the good work.